I will set out the key objectives and takeaways for the discussion today as soon as I have introduced a panel, which I'm very pleased to have with me today. Lynden John, Managing Director of SGG Cayman, our subject matter expert who will be helping us unpack, rehash, and repack the issue. Good morning, Lynden.
Hey, everybody.
And I'm also, just actually while we've got you, Lynden, I was hoping to make a joke at Cayman's expense because we're suffering with temperatures of about, 33 degrees in London, but having had a look at Google a little bit earlier, I see you're probably up in the lower 30s yourselves, so the chance to get one over you in that respect is gone amiss.
I think it's because of all the hot air at Parliament at the moment that's causing all your heat.
Right. I'm also joined by Gerhard Grueter, Managing Director of the Lawson Connor Group, who heads up the London offices of Lawson Connor. Good afternoon, Gerhard.
Good afternoon, everyone. Looking forward to that webinar today.
Fantastic. And also Joe Woodbury, a Director within the Investment Management Solutions team of Lawson Connor. Afternoon, Joe.
Good afternoon, Dorian. Good afternoon, everyone. Thanks very much for joining. Likewise, very keen to be participating in today's webinar. Thank you.
Grand. So what are we looking to achieve in the next half an hour? Well, we'll increase your understanding of what the key AML regulation changes are in respect to Cayman, who will be affected and how they might impact your Cayman entities, when do they take effect and the possible consequences if you do not comply, who can undertake the role of the Money Laundering Reporting Officer, Compliance Officer and Deputy Money Laundering Reporting Officer, how do you demonstrate AML compliance, and we'll look to give you some insight into how fees might be applied in dealing with this issue. So just to kick us off, Joe, if I could start with you, please. Can you summarize the latest Cayman AML changes, who will be affected and what the impact might be and when these take place?
Yes, absolutely. Thanks so much, Dorian. So just by way of background for those of you that are joining today, the new Cayman AML regulations apply to regulated funds registered with CIMA as well as unregulated investment entities, for instance, such as private equity or closed-ended funds, and also structured finance vehicles that are not registered with CIMA. Now, CIMA originally provided a deadline of 30th of September this year for the appointment of 3 or 4 new functions. Firstly, there was an AML compliance officer, also a money laundering reporting officer, and a deputy money laundering reporting officer as well, otherwise known as the MLRO. Some really, really useful acronyms for all of these to try and remember as well. So these were required for both registered and unregistered Cayman investment entities in existence prior to the 1st of June 2018. So in relation to your question, Dorian, about the different timelines, it depends on which side of the deadlines you fall and what type of entity you are. So you have either these 2 dates, the deadline for 30th of September 2018, and also this one for the 1st of June 2018 as well. Now, from the 1st of June 2018, new entities being created must be able to immediately demonstrate compliance with this requirement. Registered funds will need to designate the AMLCO, MLRO, and the MLRO via the REIFs portal. CIMA has no current plans for REIFs filings by unregistered investment entities. However, such entities may have to otherwise demonstrate their AMLCO, MLRO, and DMLRO appointments and the compliance with AML regulations in due course.
Thanks, Joe. So it's likely there's more to come. And Gerhard, what happens if we don't actually comply with these requirements?
I think that's never really an option to say should we judge against the risk of non-compliance with the penalties out there. The penalties, just like with any other regulatory framework, can be very high. You may receive a summary conviction, which is up to $625,000. There's even an administrative a level of administrative fine for breaches of up to $1,250,000. But I think looking at these penalties, what's really important is it is about reputation risk as well, and you do not want to have any breaches around anti-money laundering regulations. Investors are not forgiving around these breaches under any regulatory framework, and that's just one of these things. Don't even consider looking at the level of penalties. Look to get compliant. I think that's the right approach in this instance.
Grand. Okay, thanks, Gerhard. So in addition to the reputational risk, talking about the potential for sizable fines and considerable inconvenience if you have to take 2 years out in prison. Lynden, if I can bring you in here, please, do you think the regulator will be aggressive in pursuing non-compliance?
I believe so. I think the general, I think if you take a step back and have a look at the motives for putting these rules in place, are two parts. The Cayman Islands is a tax-neutral jurisdiction, and with recent events with Panama Papers and Paradise Papers, offshore gets a bad rep, and big industries or countries such as the European Union and the United States, they start to look at offshore jurisdictions with a much bigger microscope. There's a thing called a blacklist, and over the last couple of years, Cayman has continually and proactively ensure that we are ahead of regulations and requirements for transparency, tax reporting, and so on. So this is just another step in that direction. And that's to ensure that as an offshore jurisdiction, we are in compliance and we meet the Europeans and the Americans' expectations. And by doing so, it will allow us to keep our doors open for business. And it's the business that we want to do, which is, proper hedge funds, proper private equity. And that's the main reason why we're seeing it. And I think the regulator will take a very strong stance against those people that will tarnish not just their fund's reputation, but the reputation of the island as a whole. We saw what Panama Papers did to Panama. That's a very different beast to Cayman. But that's the first issue. The other one is also revenue generation. The regulators cannot squeeze more fees out of our funds and out of our different entities that we have in Cayman. And so, one of the best ways to create revenues is through punitive measures. And if you are ensuring that people are complying so that we have more business in the Cayman Islands, it is a measure now that CIMA can take to actually collect additional revenues. And we've seen these steps now over the last couple of years, not just with money laundering rules, but with directors regulations, licensing requirements for the directors. And so I think we're going to see a lot more aggressive, a lot more robust regulator in the next couple of years.
Right. Okay. So it all seems to make commercial sense. And for each registered fund, they will need to designate an AML CO, an MLRO, and a DMLRO. Joe, who can undertake these roles?
Yeah, so actually, Dorian, it's a similar approach to when we think about appointing compliance officers here in the UK. It's not really so much that you have to meet specific qualifications, but there's a general feeling and understanding that someone is adequately suitable for the role that they might entail. So that might be a natural, autonomous, independent person with the sufficient time to really know and understand the role effectively. So the CIMA do use this term about a fit and proper person, much like the FCA as well. So that person should have a comprehensive understanding of the roles and responsibilities of each function and what is required from them in line with the new regulations. Now, there's also another important point to mention. There's no blanket disqualification from being a designated AML officer if you already have an existing relationship with a particular fund or vehicle or the service or the fund's service providers as well. So that means that if someone is already a director to a fund, they can still fulfill or carry out one of these designated roles. CIMA has clarified the following persons as examples can take on this AML officer appointment. So directors, both the investment manager, appointed directors, and independent directors, any of the investment manager employees as well, any administration staff, and other service providers, legal providers, for instance.
I see. So could I be the compliance officer or money laundering reporting officer?
Yes, absolutely. Dorian, as someone as well skilled as yourself, then absolutely. As long as you meet some of the points that we talked about above, then yes, you can.
And is there a limit to how many appointments I could take on?
Well, we understand from CIMA that there's no current intention to place a limit on the number of different AML officer appointments that one individual can take on. But however, I think it's important to note that an individual needs to be able to demonstrate that they have that available amount of time and are devoting the adequate level of resource required. So they certainly don't want to see someone taking on hundreds of these roles or appointments, because clearly it's not possible for them to be giving sufficient time.
And what about having to be based in Cayman?
No, there's actually no requirement for that either. But again, I think it's an assessment has to take place around who is the right person to fulfill that role. Is someone based in London or Jersey best place to deal with those appointments, or does it make more sense to have someone locally based, which I think Lynden will touch upon shortly as well.
I hope he does. Lynden, given these options and being based in Cayman yourself, who would you recommend, or rather, I suppose, don't the administrators already provide this service, is a question that I'm wondering.
Again, I think it's one of those, when everything's new, everybody gets very excited and wants to offer a new service. But the one thing that we should remember is that anti-money laundering regulations and anti-terrorism regulations are not new. And that the service providers, the fiduciaries and legal counsel, prior to these regulatory changes, should have already been doing adequate anti-money laundering policies and procedures. The difference that we have now is that the regulations now actually make somebody responsible and actually say you are responsible to ensure there's a compliance. And this is more so because previously unregulated funds, so particularly the private equity funds or closed-ended funds, didn't really fall into the AML regulations per se. So with that in mind, the best person that we would obviously see would be ourselves, naturally. I would be short selling my business otherwise. But there are different arguments for which service provider is best, and each of the types, the administrators, the directors, and the legal counsel have their different arguments. For us, we believe the administrator, and particularly if you have a Cayman-based administrator, should be your first choice. And the reasons are quite simple. The Cayman administrators by law have to be licensed and regulated by the Cayman Islands Monetary Authority. And by default, we already have very stringent anti-money laundering policies and procedures in place. They've all been updated to match the recent changes in the law. And just by natural process, it's what we do every day and every night as we go through our work. We have to apply those to our clients. And so by default, those policies and procedures we will follow and stick to our standard to ensure that the funds are in compliance. And with that, we also have a much higher overview of everything that's happening in the fund as an administrator, because we're accounting for everything. And the money laundering regulations for MLRO are two parts. The one is capital coming in and out, which is quite easy for an administrator because we normally are the RTA and we do the subscriptions and redemptions or capital acquisitions and withdrawals. But we also account for the investments and trades. So we do have a very good, I'd say, view of what's happening all the time. As a fiduciary, depending on the nature of the fund, you would have some oversight. Normally it's retrospective, a couple of months down the line, because you've delegated the investment activity to the manager. So you may be present, but it might be, from a timing point of view, it would be 3 or 4 months, or maybe once a year at a board meeting, that you'd go back and ask the retrospective questions. Whereas an administrator would be in the mix of it, and it should be more timely from a compliance point of view.
Yeah, it's quite an interesting point, and just wanted to make everyone know, and all the attendees, that as we're going through this, if you have any interesting questions you wanted to ask, we're just going to address in the end. Feel free to just hover up to the top of the webinar portal, and there should be a Q&A button there. You can ask any questions, but I'll pass it back over to Dorian.
Thanks, Alex. Lynden, thanks. So you've covered a Cayman-based solution. What about outsourcing to administrators or directors or service providers in equivalent jurisdictions?
So it's actually a nice part of the law. The Cayman laws are quite straightforward, but they're not restrictive. And when I say this, it means that if you're in a jurisdiction, say, for example, Jersey or Bermuda, where you have equivalent anti-money laundering regulations, the Cayman authorities will accept that, and you can delegate to administrators or to service providers in those jurisdictions. By being in an equivalent jurisdiction, though, it's not a blank check. You can't just say, oh, you're an equivalent jurisdiction and tick the box. You will need to perform a gap analysis. And this means that, your administrator needs to actually sit down per entity, or depending how you want to do it, but you'll have to actually demonstrate that what you're doing is in line with Cayman law. And so that gap analysis will have to be done and documented and put onto the files, so that if you ever get tested by the regulator that you are in compliance, you can show and demonstrate this. So depending on how those other service providers want to tackle this, most of them will try levy those costs of doing the gap analysis into their fees. So, my gut is, if you're going to deal with a jurisdiction that regulation has punitive and criminal damages if you get it wrong, it would always be better to rather use a Cayman-based service provider to assist you. In many instances, we currently assist many administration firms with the regulatory compliance that are not based in Cayman, and it just gives their directors a peace of mind that they have somebody who's closer to the pulse in Cayman, making sure that what they're doing isn't going to get them inadvertently into trouble.
Right. You've mentioned the gap analysis. Can you just give us a little bit more, perhaps give us an example of the type of thing that you would expect that to consist of?
So the gap analysis is actually quite an interesting one, and I'll give you a live example. I'm busy working on a company that has Kuwaiti investors, and when we put it through, we have to do what we call a risk-based analysis now. And as you go through understanding whether or not your client is suitable, or whether you need additional enhanced due diligence under the Cayman methodology, and looking at all the different bits and pieces that we have, we've been able to put our client as a medium risk. But when I deal with a different jurisdiction who's working with the same client on a different part of the structure, they don't. They see it as a low risk. And so there's a gap there between the two. And what it causes is that at our level, the KYC and the enhanced due diligence that we've been asking for, because there's some elements in there that we need to do some extra work, they're not required to do that in the other jurisdiction. So in that case, if you were the money laundering reporting officer or the compliance officer in this point, you would have to do a gap analysis and identify that. And you would also have to then report it to the board. And the reality is, if you are complying to Cayman anti-money laundering rules, and in this case, it's a private equity fund, so they have to, that gap needs to be rectified. There's a couple of things to do and it's quite easy to fix it. But if you didn't identify and didn't fix it, you could be in breach of the regulations. So that's the one area of the gap. Excuse me. The other is filing of Sars. So one of the biggest concerns for CIMA with outsourcing to another jurisdiction is actually filings. In Cayman, we have a thing called a reef system. So if you are a hedge fund right now, your administrator would be registered on Reefs, which is the online website for CIMA. And so as the appointments are made, CIMA will be notified. But what we often find is when you have outside service providers from outside the jurisdiction, they're either not on the systems that you need to be on, or they're not familiar with how to report to CIMA, or they don't know that they have to tell CIMA certain things. And the biggest risk with money laundering is if you have a suspicious activities report. That goes to your MLRO. The MLRO will assess whether or not it needs to be filed. Now, some countries might file it with their regulatory bodies. So if you're in Jersey, it might go to the Jersey FCA, for example. The issue with that is it shouldn't go there. It needs to go to Cayman. Now, if you're charging your client per filing, which many service providers will do because each of those are unique files, if you're in a regulatory environment that's not just Cayman, you might have to do that twice. So you might have to say, let's say in Bermuda, you might have to file it to the Bermudian authorities, and you have to file it to the Cayman authorities. So by default, you might end up with two reports. And if both those regulators come back with queries, you end up kind of putting yourself in a duplication scenario. And while hopefully not many people have to file many Sars, that's some of the concerns and debate that's been raised. And just to, a lot of these questions right now that we're having is our interpretation of the rules and what we've got from different dialogues between the different firms. We do expect CIMA to issue guidance later on, hopefully sooner than later, that will help clarify some of these items, so that as we go through these different bits and pieces, outside service providers will be able to work out what they're supposed to be doing as well.
Right. Okay. Thanks, Lynden. I'm just going to come. Can you give us a very brief insight into what the three roles would actually do?
All right, so the AMLO and the deputy AMLO are pretty much the same role. One is for when the MLRO is absent for leave or not available, the deputy steps in. And that role is the reporting officer. So if there is a suspicious activity or there needs to be something signed off by compliance, that would be their role. The more important role is the compliance officer itself. That's the individual who will obviously read all the policies and procedures and make sure that they are consistent and compatible with the regulatory requirements, and also ensuring that they are getting enough information from the different parties inside a fund, for example, the directors and the investment manager, so that they can then assess that the AML PMPs are being put in place and are being followed correctly. And that compliance officer, and it depends on the nature of the entity and the nature of investments, will then determine what the frequency of those reports will be, and will make those reports to the board or the manager as necessary. They'll also be responsible for liaising with the regulatory authorities and ensuring that if there's any communication on these matters, that they would then obviously present and respond to any issues that arise from time to time. So those are the three roles in short.
Okay, and I guess that brings us on to the question that everybody wants to hear the answer to. What are the typical fees for these particular roles?
So I serve as a fiduciary, and I also run an administration firm. So I get to see a lot of different fees all the time. But for these roles at the moment, fees are all over the place. We're seeing fees as low as $3,500 all the way up to $15,000. We've got some guys charging a massive base fee of $15,000, and that's an annual fee, not a setup fee, plus time spent. And we're seeing other guys doing a bit more pragmatic approach, which is a much lower base fee with ad hoc fees added onto it. But the reality is you've got to take the step back and say to yourself, what are we doing? What is my structure? Is it a high risk structure? Is it a medium risk structure? Do we have these elements in place? And have we spoken to our service providers? So, getting three proposals from your current service providers would be a smart way to look at this. Some people only go to their legal providers, some only go to the administrators, so they don't get a feel. And what I've been recommending to our clients is, once we've proposed, is to understand what we're going to do. And we've talked them through a plan. We've explained how we're going to tackle it. We explained what the fees are entailing. And from there, the clients will get a good sense of whether they're getting a fair fee or not. We saw this with FATCA. FATCA came out with some very harsh legislation, and originally it was going to be the end of the world, and the US government was going to keep 30%, and fees started off very, very aggressive. It got to the stage now, it was all corrected, guidance notes came out. It was more of a softer approach, a lot fairer approach as well. And we saw fees drop from $7,500 for a PPOC all the way down to $1,250. And so I do say that, if you don't understand the money laundering rules or what the changes are, the first step is to talk to your service provider, ask them to articulate what these are, ask them to articulate how they envision themselves performing these roles, and then that will give you a good sense of what your fee should be.
Okay, thanks, Lynden. I'm conscious of time, but Gerhard, before we go to the audience Q&A, I know we've got at least one of the, in fact, we've got several questions, which we might not have time for, unfortunately, but can you tell us why Lawson, Connor and SGG are a preferred service provider for AML compliance?
Oh, thank you, Dorian. That question comes out of the blue, but I'm prepared to answer that. I think what's special is that SGG is local. It's got its Cayman office. Lynden, John, is one of the most experienced persons in that sector locally, and at the same time, you have a local representative here from Lawson Group with representatives in the key jurisdictions. So I think when it comes to implementing MLRO solutions for Cayman-based funds, the important thing is that you might want to have a local contact person in your jurisdictions where you're based as a manager, and at the same time, you have a local representative in Cayman who is part of one of the largest investor services firms in the world, who has the necessary licenses to provide services locally, and this is also plugged in about any changes. And I think it's a combination of the two which might benefit our client base, and what we have seen so far. We have seen quite a lot of take up on that combination, and yeah, I think that's quite unique in the market at the moment.
Super, thank you. And can I just thank all of the panelists for their contributions so far. We have got a couple of questions. Lynden, I'll put the first question to you if you don't mind. Can you comment about the fact that the revised regulations also extend to downstream investment activities?
Absolutely, and that's a very good aspect to look at. And we touched on administrators earlier with RTA. So administrators obviously do the capital in, the capital out. But what about investments? And by default, as a director or fiduciary, we should already be asking what due diligence has been done. Do we know who we're doing business with? And we should, you know, if you're dealing with a jurisdiction that might be a little bit gray, we should do some wall checks or make sure that somebody's actually ensured the people we're doing business with are above board. And now that this role's been defined by the regulator and it's crystallized that this is actually expected, what we will see is that the MLRO or the CIO will actually ask the different parties involved. So if it's an investment advisor or the directors, what are the policies and procedures around, say, doing a private acquisition of an aeroplane? Have we done a due diligence check? Have we done background checks? You know, is the party we're dealing with on an OFAC sanctions list? If there's no policies and procedures in place, it will be identified during the initial review process, and then those can be adopted to suit and tailor the funds. And to give you an example how this affects fees, if I'm sitting as a CEO on a private equity fund, but the private equity fund is acquiring long-term positions in shares on the NASDAQ, that's a pretty low risk of AML issues because you're going through a regulated exchange. There'll be obviously a process documenting this somewhere to explain, you know, the risk approach to it. But your fees then would be much lower than, say, for example, I sit in a company where we buy and sell aircraft from very small counterparties. Some of them are in Eastern Europe, some of them in North Africa. But every transaction that we do a background check, a wall check, and an OFAC check to make sure that the parties that we're dealing with are above board. So that role now is crystallized. And when it comes down to the investment portion, the main thing is, you know, what are the fiduciaries or the advisors who have been delegated the investment activities doing to ensure that we know who we're doing business with and that it's above board, and have we documented it is the key. And if we haven't done it, how do we rectify it? If we are doing it, is it being efficient and effective, and is it being consistently applied? So that's how I would look at that question.
Right, okay. Thanks, Lynden. I'm just having a look to see what other questions we've got, but I'm conscious. Where are we time-wise?
Time-wise, we're just about to gonna wrap it up now. There are a few of you who have dropped questions through, and we'll do our best to get to you individually. We really appreciate all the input on that, and the interaction with the attendees really makes these webinars, you know, quite interesting for us. But that's all we have time for today. I'm going to leave you on this page for a couple minutes, the contact us page. If you guys are interested in any of the topics we discussed today, want to learn a little bit more about, you know, what's happening in the Caymans, you want to speak to Joe Woodbury or Linda John at SGG, and all their contact information is there. We also have phone numbers for you dialing in internationally, if that's easier for you. But we want to take this time to say thank you very much for joining our webinar today. And we will be sending a sort of wrap-up email off the back of this session. And everyone have a great rest of the week. Thank you very much, Joe, Dorian, Gerhard, and Lynden. Thank you very much.
Thank you.
Thanks very much.